The crowd cheers loudest right before the slaughter. Every tick higher felt like validation until it wasn't. That euphoric breakout above resistance. Smart money was selling into your excitement. The buying climax isn't opportunity, it's the transfer. Strong hands offloading to weak hands, using your greed as their exit liquidity. Every upthrust, every false strength, engineered deception. But here's what changes everything. Once you recognize the ICE, the LPSY, the shrinking demand beneath the surface, you stop being the counterparty. You become the predator. You have watched it happen. Price climbing for weeks. Every financial channel screaming the same headline, bulls in full control. Your portfolio is green. Your confidence is swelling. The momentum feels unstoppable. Then one morning, without warning, the tape turns against you. The very breakout that seduced you into buying, that clean, powerful surge above resistance, becomes the precise moment you realize something went terribly wrong. Your stop triggers. Your account bleeds, and you sit there asking the same question every uninformed trader asks too lately. Who was selling while I was buying? Pause there. Before you answer that question impulsively, before you blame algorithms or manipulation or bad luck, sit with the discomfort of that chart for a moment longer, because the answer is not found in the news. It is not found in earnings reports. It is found in the only two witnesses that never lie: price and volume. Here is what the tape was telling you, had you known how to read it. When price surged aggressively through that resistance level with enormous volume, the uninformed trader saw confirmation of strength. What was actually occurring was a buying climax, the final, desperate transfer of stock from strong, professional hands into the eager, emotional hands of the public. Think carefully about the mechanics. Large institutional operators, smart money, cannot liquidate millions of shares quietly. They need a crowd of willing buyers. They need euphoria. They need breakouts that trigger momentum algorithms, retail FOMO, and stop buy orders simultaneously. The explosive candle you celebrated, that was their exit door, engineered with surgical precision. The preliminary supply appeared weeks earlier, subtle resistance that most dismissed. Then the buying climax printed, wide range, climactic volume, closing near highs. The automatic reaction followed, carving the lower boundary of the range. And throughout Phase B, every minor upthrust into resistance absorbed the last remaining demand, while the wise wave volume told the silent truth: upward waves shrinking, downward waves strengthening. The upthrust after distribution was the final deception. One last push above highs, triggering breakout buyers, harvesting their liquidity before the major sign of weakness collapsed the entire structure through the ICE. Modern markets execute this same campaign across every time frame, whether it is Bitcoin on a 15-minute chart or S&P futures on a weekly chart. The instruments change. Human psychology does not. This knowledge does not merely protect your capital, it repositions your perspective entirely. When you understand that strength is manufactured at tops specifically to attract uninformed participation, you stop chasing breakouts blindly. You begin reading volume character. You begin identifying the ICE, the LPSY, the shrinking demand hidden beneath surface momentum. The professional does not fear the top. He studies it and trades from the other side. The buying climax isn't opportunity, it's the transfer. Strong hands offloading to weak hands, using your greed as their exit liquidity. You felt it in your chest, that unmistakable pulse of certainty. Price had been climbing steadily for months. Every pullback was shallow, every recovery swift. The narrative was clean, the fundamentals compelling, the momentum undeniable. Social media confirmed your bias. Your trading group confirmed your buyers. The volume surging on that final explosive candle confirmed your bias. So you bought. And the moment your order filled, the moment 10,000 traders, just like you placed that identical market order at nearly the identical price level, something shifted beneath the surface that no headline would ever explain to you. The distribution was complete. The transfer was done. Study that moment carefully before moving forward. Do not rush toward conclusion. Do not dismiss this as conspiracy or manipulation beyond your understanding. The financial markets operate under laws as precise and observable as gravity itself. Everything the professional operator does leaves evidence. Your singular task is learning to read that evidence before the consequence arrives, not after. The tape does not hide the truth. You simply were never taught to see it. Here is the anatomy of what actually occurred. Long before that climactic surge, institutional operators, the strong hands, had been accumulating enormous positions during the preceding markdown. Their average cost was significantly lower than current price. Now, weeks or months into the uptrend, they face one unavoidable problem. They need to sell millions of shares without collapsing the very price they are selling into. This requires an audience. This requires your greed. The preliminary supply was their first quiet attempt, a subtle resistance test that attracted little attention. When demand absorbed that supply effortlessly, the operator recognized the crowd was hungry enough to sustain one final campaign. The buying climax was then engineered, wide expanding ranges, surging volume, price accelerating beyond logical resistance. Every technical signal that modern momentum algorithms and retail breakout strategies are programmed to chase simultaneously. In that single climactic bar, the professional is not buying alongside you. He is selling directly into your enthusiasm. Your market order is his exit liquidity. Your stop, buy trigger is his distribution mechanism. The automatic reaction that followed was not random profit taking, it was the market revealing, for the first time openly, that aggressive demand had been absorbed and the path of least resistance had quietly reversed. Every subsequent rally throughout Phase B, every upthrust, every minor push to new highs was another transfer, another withdrawal of stock from strong hands into weak ones. The Wheeze wave told the story clearly, rising waves carrying diminishing volume, falling waves carrying increasing conviction. Modern markets, whether equities, crypto, or futures, execute this transfer identically. Only the speed changes. Once you internalize this principle completely, a profound shift occurs in how you read every chart. You stop seeing volume spikes at highs as confirmation. You start seeing them as invitations to the wrong side of someone else's trade. Every upthrust, every false strength, engineered deception. The breakout looked absolutely legitimate. Price had been consolidating respectfully beneath a well-established resistance zone. Volume was building. The technical pattern was textbook clean. Every indicator you trusted, every moving average, every momentum oscillator, aligned in perfect agreement. When price finally pierced that resistance with authority, breaking cleanly above weeks of congestion, your conviction was not emotional. It felt logical, calculated, confirmed. You entered long. Dozens of algorithmic strategies entered simultaneously. Retail traders across every time zone entered together, all reading the identical signal, all acting on the identical trigger, all arriving at the identical conclusion at the identical moment. Then price reversed, violently, completely. Personally, do not react to that reversal yet. Do not immediately conclude that markets are random, that technical analysis is broken, or that institutional operators possess some unfair supernatural advantage beyond your reach. Before forming any conclusion about what destroyed that trade, examine precisely what the price and volume told you in the moments leading directly to that upthrust. Because the evidence existed, every piece of it. Openly visible on the chart you were already watching. You simply did not know the language it was speaking. The upthrust is not an accident of market mechanics. It is a deliberate, precisely engineered maneuver executed by operators who understand one fundamental truth about modern markets that most retail participants never discover. Liquidity congregates above resistance, and liquidity is the only thing large operators truly need. Consider the structure of what occurred. Throughout Phase B development, the operator had been quietly studying the market's response at both extremes. Each test to the upper boundary, each minor push toward resistance measured the remaining quality of demand. Was buying aggressive or hesitant? Was volume expanding or contracting on each rally attempt? Were ranges widening with genuine conviction or narrowing with manufactured appearance? When those tests began revealing shallow volume on upward thrusts and increasing conviction on downward reactions, the operator identified his moment. Above that resistance level sat an enormous concentration of stop-loss orders from existing short positions, breakout buy orders from momentum traders, and algorithmic trigger points from systematic strategies. That single resistance break, the upthrust after distribution, simultaneously triggered every one of those orders. The resulting volume surge was not bullish confirmation. It was the operator absorbing every single buy order with his prepared selling position. The wide-range candle that pierced resistance was not strength. It was the professional harvesting every available liquidity pocket in one decisive movement before allowing price to collapse back through the ICE. Modern crypto markets demonstrate this pattern with particular clarity. Bitcoin's most devastating reversals have consistently originated from precisely this upthrust mechanics: clean breaks above psychological resistance, maximum retail participation, immediate aggressive reversal. The asset changes, the operator's methodology never does. The minor upthrust within the range served the same function at a smaller scale, testing local highs, absorbing residual demand, confirming the absence of genuine buying conviction before the major sign of weakness delivered its verdict. Understanding this single principle permanently transforms your relationship with breakouts. You no longer chase every resistance break impulsively. You observe volume character. You study the quality of the move. You ask whether the operator has genuinely committed or whether he is simply harvesting the crowd one final time before revealing his true directional intention. The upthrust does not signal opportunity for the uninformed. For the educated observer, it signals exactly where the professional has just shown his hand. Once you recognize the ICE, the LPSY, the shrinking demand beneath the surface, you stop being the counterparty. You become the predator. There is a specific moment every serious trader eventually confronts, not a winning trade, not a profitable month, something far more permanent and far more valuable than either. It is the moment you sit before a chart, one that previously confused you, frustrated you, humiliated you repeatedly, and suddenly the entire structure speaks with absolute clarity. The rallies that seduced you into buying now reveal themselves as last points of supply. The support levels that gave you false confidence now expose themselves as the ICE, that critical boundary below which distribution completes its final verdict. The shrinking volume on every upward attempt, the expanding conviction on every downward push, details you once ignored now scream with unmistakable authority. In that single moment, something irreversible shifts inside your understanding. You realize you have been the counterparty. Every single time, sit with that recognition before proceeding. Because understanding what you were doing wrong is not sufficient. Countless traders identify their mistakes repeatedly without ever correcting them, because they never understood the structural mechanics that created those mistakes in the first place. Before you can position yourself alongside the professional operator, you must understand precisely how the distribution structure confirms its directional verdict through the ICE and the last point of supply. The evidence has always been present. Your new responsibility is reading it with the discipline and patience the methodology demands. Here is what the educated eye now observes where the uninformed eye once saw only noise. The ICE is not merely a support line drawn mechanically beneath price. It represents the lower boundary established by the automatic reaction, the first honest revelation that aggressive demand has been absorbed and genuine selling interest has entered the market. Throughout Phase B and Phase C development, every test of this boundary was a measurement. The operator was asking one precise question with each approach: is there sufficient demand remaining to complicate my downward campaign? Each test answered that question through volume. Diminishing volume on approaches to the ICE confirmed progressive exhaustion of buying interest. The crowd that once defended this level aggressively was thinning. Conviction was evaporating, and when the major sign of weakness finally drove price through that boundary with expanding ranges and decisive volume, the verdict was delivered without ambiguity. The last point of supply then appeared with elegant predictability. That final upward rally following the IC break, narrow ranges, contracting volume, price struggling visibly against the weight of overhead supply, was the operator's gift to the educated observer. One final opportunity to position short before Phase E delivered the full consequence of the distribution campaign constructed across weeks or months of deliberate preparation. Modern markets present this identical sequence across every instrument and every time frame. The LPSY in Bitcoin following an ICE break carries precisely the same structural significance as the LPSY in an S&P futures distribution. The Wace wave confirms it, downward waves strengthening progressively, upward waves losing momentum measurably, the imbalance between supply and demand becoming undeniable to anyone reading the tape with trained eyes. The shrinking demand beneath the surface was never hidden. It was always broadcasting its message through volume character, through the quality of each rally attempt, through the ease of each downward movement, through the progressive deterioration of buying conviction that the operator methodically engineered throughout the structure's development. This knowledge does not merely improve your trading. It fundamentally repositions your entire market identity. You no longer arrive at distribution tops as eager, emotionally driven liquidity for the professional operator. You arrive as an informed, patient observer, reading the ICE, identifying the LPSY and measuring the shrinking demand, and positioning yourself in precise alignment with the operator's already confirmed directional campaign. The predator does not chase price. He studies structure, reads the tape with disciplined patience, and strikes only when the market's own evidence demands it. But here's what changes everything. Distribution structures don't just warn you. They hand you the professional's complete playbook. You have survived the education that most traders never receive. You have felt the buying climax seduce you at the top. You have experienced the upthrust trigger your breakout entry at precisely the wrong moment. You have watched the ICE break beneath your long position while you desperately searched for logical explanation. You have been the counterparty, the willing, uninformed liquidity provider that every distribution campaign requires to complete its transfer successfully. That education cost you real capital, real time, real confidence, and somewhere inside that accumulated pain sits a question that separates the trader who eventually succeeds from the one who permanently quits. Is there a systematic, repeatable way to read what the professional operator is doing before the consequence arrives? Before answering that question with the certainty it deserves, understand something fundamental about the nature of modern markets that most participants spend entire careers failing to grasp. The financial landscape has changed dramatically since Wyckoff first documented these principles. Algorithmic execution, high-frequency trading, derivatives markets, cryptocurrency exchanges operating continuously across every time zone, the instruments, the speed, the technology surrounding price discovery have transformed beyond recognition. What has not changed, cannot change, is the underlying human psychology driving every campaign. Large operators still require liquidity to build and unwind significant positions. Retail participants still respond to euphoria and panic with predictable emotional consistency. Volume still reveals the true character of every price movement, regardless of what narrative surrounds it. The tape still speaks its honest language to anyone disciplined enough to study it without bias or emotional interference. Here precisely is what changes everything in your trading when distribution structure recognition becomes second nature. You approach every potential resistance zone with a fundamentally different analytical framework. Where the uninformed trader sees price approaching highs and anticipates breakout continuation, your trained eye immediately begins measuring the quality of demand driving that approach. Is volume expanding with genuine institutional conviction, or contracting progressively, revealing exhaustion beneath a surface appearance of strength? You study the preliminary supply not as random resistance, but as the operator's first quiet measurement of available demand. You observe the buying climax not as bullish confirmation, but as the transfer mechanism, the precise moment professional selling absorbs public buying with maximum efficiency. You watch the automatic reaction carve its boundary with new respect, understanding that this level will define the ICE, the critical threshold whose eventual violation confirms the distribution campaign's completion. Throughout Phase B, your attention shifts entirely from price direction to volume character. Each upthrust into resistance is evaluated not for breakout potential but for selling conviction. Are downward waves strengthening progressively? Are upward waves carrying diminishing volume and narrowing ranges? Is the operator confirming through repeated tests that demand is genuinely exhausted, that the path of least resistance has quietly, decisively shifted downward? When Phase C delivers its upthrust after distribution, that final engineered surge above resistance designed to harvest remaining breakout liquidity, you are no longer among the crowd being harvested. You are positioned on the opposite side, measuring the quality of that reversal, identifying the precise last point of supply where the operator's selling campaign will deliver its final confirmation before Phase E begins. The LPSY becomes your entry signal rather than your destruction. The ICE becomes your structural reference rather than your broken support. The shrinking demand you once overlooked becomes the most powerful directional indicator available on any modern chart. Across equities, futures, cryptocurrency, or foreign exchange, modern algorithmic systems have made this recognition simultaneously more challenging and more rewarding. Machines execute distribution campaigns with greater speed and precision than human operators alone could achieve. Upthrusts trigger and reverse within single sessions. IC breaks occur with overnight gap momentum designed specifically to prevent protective response. The campaigns are faster, but the structural fingerprints remain identical because the underlying supply and demand mechanics are mathematically unchanged. This is the complete transformation that genuine Wyckoff methodology delivers to the serious modern trader, not a mechanical system of rigid rules applied blindly to every chart. Not a collection of pattern labels memorized without understanding the operator psychology behind each event, but a living, breathing framework for reading the tape honestly, measuring supply against demand, volume character against price movement, professional intention against public emotional response. The distribution structure is not your enemy once you understand its language. It is the most detailed, honest roadmap the professional operator will ever unknowingly hand you, drawn in real time, confirmed by volume, and readable by anyone disciplined enough to study the tape without the interference of hope, fear, or the seductive noise of market narrative. The market does not reward the fastest. It does not reward the boldest. It rewards only the most educated observer, the one who reads what others refuse to study. Look back across everything this speech has revealed. You entered these pages as every serious trader enters the market, carrying the weight of unexplained losses, confused by reversals that seemed random, humiliated by breakouts that destroyed positions you built with genuine conviction and careful analysis. The buying climax trapped you at the top. The upthrust triggered your entry at precisely the worst moment. The ICE collapsed beneath your confidence while headlines still screamed bullish narrative. The last point of supply delivered its final verdict while you searched desperately for logical explanation that the tape had already provided, clearly, honestly, repeatedly, in a language you had not yet learned to read. That pain was not punishment. That pain was tuition, and you have now collected everything it was meant to teach. Stay with the complete picture before drawing your final conclusion, because isolated knowledge is dangerous in financial markets. Understanding the buying climax without understanding the transfer produces overconfidence at tops. Recognizing the upthrust without understanding the deception produces premature short entries. Identifying the ICE without understanding the awakening produces mechanical pattern matching without genuine operator comprehension. And possessing the edge without having earned it through the preceding 4 levels of understanding produces exactly the kind of selective, inconsistent application that keeps technically educated traders from achieving the consistent, repeatable results the methodology genuinely delivers. These 5 keynotes were never independent lessons. They were one continuous, unified revelation told across 5 chapters of the same fundamental truth about how professional operators distribute stock at elevated prices, manufacture the illusion of strength for public consumption, harvest retail liquidity through engineered upthrusts, complete the transfer through climactic volume events, and ultimately confirm their directional campaign through the ICE break and the last point of supply before Phase E delivers the full consequence of every week and month of deliberate, systematic distribution preparation. Here is what this understanding now permanently installs inside every chart analysis you will ever conduct. You no longer approach resistance zones with the crowd's emotional framework. You approach them as an investigator, measuring volume character, studying the quality of each rally attempt, evaluating the progressive deterioration of demand conviction that the operator's campaign methodically engineers throughout the structure's development. When price surges above resistance with climactic volume, you no longer feel the crowd's excitement. You feel the professional's quiet satisfaction, because you now recognize that the transfer is occurring, that your former self was once among those providing the exit liquidity, and that your educated present self is positioned to read the subsequent automatic reaction, measure the Phase B tests with disciplined patience, and identify the precise structural moment when the operator's campaign confirms its directional verdict. The upthrust no longer deceives you. The shrinking demand on upward waves no longer escapes your attention. The IC no longer represents broken support, it represents confirmed distribution, the structural boundary whose violation signals that the cause has been fully built and the effect is now mathematically inevitable. Modern markets, whether you trade S&P futures on a daily chart, Bitcoin on a 15-minute time frame, individual equities on a weekly structure, or currency crosses on an intraday basis, present this identical campaign repeatedly, consistently, and with the same observable fingerprints across every instrument and every era of market history. Because the technology changes, the execution speed changes, the instruments and the participants and the narratives surrounding every campaign change completely. But the human psychology driving every transfer from strong hands to weak hands, from professional operators to emotionally driven retail participants, has never changed, cannot change, and therefore the tape's honest language about supply, demand, volume, character, And operator intention will never stop speaking clearly to the disciplined observer who studies it without bias. Richard Wyckoff spent 40 years on Wall Street watching the game unfold with the same merciless consistency across every market cycle, every instrument, every generation of uninformed participants who arrived with capital and departed with expensive education. He documented what he observed not to expose the professional operator, but to elevate the serious student to a position where the distribution campaign, the manufactured strength, the engineered upthrust, the progressive transfer of stock from strong hands to weak, all of it becomes readable, anticipatable, and ultimately tradable from the correct side. You began this speech as a student of price action. You conclude it as something the market desperately needs more of and rewards without hesitation when it encounters genuine preparation, discipline, patience, and the educated ability to read the tape exactly as it is written rather than as hope and narrative suggest it should be. The distribution structure is complete. The ICE has been broken. The last point of supply has delivered its confirmation, and for the first time, you are not the counterparty standing on the wrong side of the professional's campaign. You are the observer who read every event, measured every volume signal, identified every phase with clarity, and positioned yourself precisely where the tape's honest evidence demanded. The market rewards only one quality above all others, not intelligence, not speed, not access to information. It rewards the trader who finally learns to read what has always been written directly in front of him. Study the tape. Trust the volume. Read the structure. The rest will follow.